Hey everyone, and welcome back to the channel. Today, we're diving deep into the world of the US stock market. Whether you're just starting out or you've been trading for years, this video is packed with insights to help you navigate the markets more effectively. We'll cover everything from the absolute basics to advanced strategies, so let's get right into it. First up, for our beginners, what exactly is the US stock market? Think of it as a massive marketplace, like an Amazon for company ownership. When you buy a stock, you're buying a small piece or a share of a public company like Apple or Tesla. The main U.S. exchanges are the New York Stock Exchange, or NYSE, and the Nasdaq. Companies list their shares on these exchanges to raise money, and investors like us trade those shares, hoping their value will increase over time. The goal is simple: buy low, sell high. But as we all know, it's not always that easy. So, how do you actually make money? Let's talk trading strategies. For beginners, a great starting point is long-term investing, or buy and hold. This involves picking solid, fundamentally strong companies and holding onto their stocks for years, letting them grow through market ups and downs. Another popular strategy is dollar-cost averaging, where you invest a fixed amount of money at regular intervals, regardless of the stock price. This helps average out your purchase price over time and reduces the risk of buying everything at a peak. Now, for our more experienced traders, you might be looking at strategies like swing trading or day trading. Swing trading involves holding stocks for a few days or weeks to profit from short-term price swings. This requires a good understanding of technical analysis to identify potential entry and exit points. Day trading is even more intense, involving buying and selling stocks within the same day. It's high risk, high reward, and requires immense focus, discipline, and a solid understanding of market dynamics. Remember, day trading isn't for everyone and can lead to quick losses if you're not careful. This brings us to one of the most crucial topics in trading: risk management. I cannot stress this enough. Protecting your capital is your number one job as a trader. Before you even think about profits, you need a plan to manage losses. A fundamental rule is the 1% rule. This means you should never risk more than 1% of your total trading capital on a single trade. For example, if you have a $10,000 account, you shouldn't risk more than $100 on any given trade. Another key tool is the stop-loss order. This is an order you place with your broker to automatically sell a stock if it falls to a certain price, capping your potential loss. It's your safety net. Never trade without one. Let's get into the nitty-gritty of technical analysis, a tool used by traders of all levels. At its core, technical analysis is about reading charts to predict future price movements. One of the most basic but powerful concepts is support and resistance. Support is a price level where a stock tends to stop falling and bounce back up because there's a high concentration of buyers. Resistance is the opposite. It's a price level where a stock struggles to break through as sellers take over. Identifying these levels on a chart can give you clear entry and exit points. When a stock breaks through a resistance level, that level often becomes a new support level. Mastering this concept alone can significantly improve your trading decisions. Beyond the charts and strategies, there's a huge component that often gets overlooked: trading psychology. The market is driven by two powerful emotions: fear and greed. When prices are soaring, greed kicks in, and you might be tempted to jump in without a plan, fearing you'll miss out. When prices are plummeting, fear takes over, and you might panic sell at the worst possible time. The key is discipline. You must have a trading plan and stick to it no matter what. Your plan should define what you'll trade, when you'll enter, where you'll take profits, and where you'll cut losses. Trading with discipline means executing your plan like a robot, removing emotion from the equation. Successful trading is 80% psychology and 20% strategy. Now let's broaden our scope beyond individual stocks. There are other powerful instruments you can trade: options and ETFs. ETFs, or exchange-traded funds, are like baskets of stocks. For example, an S&P 500 ETF holds shares in all 500 companies in the index. This is a fantastic way for beginners to get broad market exposure and diversify their portfolio instantly without having to buy hundreds of individual stocks. They trade just like a regular stock, making them super accessible. Options, on the other hand, are for more advanced traders. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price by a certain date. Options offer incredible leverage, meaning you can control a large number of shares with a relatively small amount of capital. This can lead to massive returns, but it also comes with significantly higher risk. The value of options can go to zero very quickly. If you're interested in options, you must dedicate serious time to education before putting any real money on the line. Start with paper trading to practice your strategies without any financial risk. Let's tie this all together with some final tips. First, continuous education is non-negotiable. The market is always changing, and you need to keep learning to stay ahead. Read books, watch videos, follow reputable financial news, and never stop being a student of the market. Second, start small. Don't jump in with your life savings. Begin with an amount you're comfortable losing. This will allow you to learn the ropes without the emotional stress of risking essential funds. Third, find a community or a mentor. Trading can be a lonely journey. Connecting with other traders can provide support, new ideas, and help you stay accountable to your plan. And finally, remember that trading is a marathon, not a sprint. There will be winning trades and losing trades. The goal is not to be right every time, but to have your winners be bigger than your losers over the long run. Focus on the process, stick to your plan, and manage your risk. That is the path to consistent profitability. If you're ever feeling overwhelmed or finding that trading is negatively impacting your mental health, please take a step back. It's okay to take a break and reassess. Your well-being is always the top priority. There are resources available, and talking to a professional can make a world of difference. Your mental capital is just as important as your financial capital. Alright, that was a lot of information, but I hope it gives you a solid framework for your trading journey. We covered the basics, dived into strategies, emphasized risk management and psychology, and touched on different trading instruments. Remember to do your own research and find what works best for you. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more content on mastering the markets. Let me know in the comments what topic you'd like me to cover next. Until then, trade smart and stay disciplined. See you in the next video.